Good morning, everyone, and thank you for joining us. So, good morning. Thank you, Ruth. Today is about education. Our focus is, as you can see, avoiding tax surprises. My name is Susan Sino, and I'm with the Spring Point Foundation, and we are your foundation. So your donations to the Spring Point Foundation come back here to Monroe Village. But today is more about education, and we can talk more about donations another day. Unless you want to talk afterwards, I'm happy to listen and share my information. The important part to remember is each of you have a unique, different situation. Your family situation is different, your financial situation is different. So what you're going to see today, write some notes down, see what's important, then works for you. If you have questions, please come ask myself or Bill afterwards. Our information is in the handout, so you can email or call us after, and we'd be happy to help you. So again, today is about you and some information. As a side note, we're going to do another presentation in November on a different topic, which is also all about education in your finances. So by the time we get done, we have another one in January, I think you will be well versed. And then we'll find some new ones because the tax laws change all the time, and our friend Bill here is an expert on tax law and how they affect us. So are you ready to get very much into happy items? Ready? The enthusiasm is amazing. All right, we have brought along from Green Oak Consulting a gentleman by the name of William McMorran. And Bill has been in the industry, gosh, how many years, Bill?
A while.
Quite some time. He is the leading expert in reference to taxes and donations and estate planning when it comes to seniors. So you all are really very fortunate to get the benefit of listening to some of Bill's wisdom. So please welcome William McMorran.
Just go here, I guess. Morning, everybody. Can everybody hear okay? Okay, good. Thank you. It's great to be here. Susan is quite kind and gentle in saying what she says about me, so please bear with me. I hope I can only live up to it. Our talk today is about avoiding tax surprises, and with every presentation I like to start with a quote. This is from the golfer Lee Trevino, who said, "My divorce came to me as a complete surprise. That's what happens when you haven't been home for 18 years. Whenever I make a presentation, I always like to establish a few ground rules. The first one is that everybody has a different perspective about everything, about money, about taxes, about politics. Everybody's different, and there are no right answers to your own situation that fits everybody. There are no right answers. It is what is best for you. And today, there's no pressure to take any actions whatsoever, because I always stress it's important to talk to your own advisors about what is best in your own situation. So you may ask me a question later, and I hope you'll have questions. We may ask something very technical, and my answer will be talk to your own advisors. It's sort of an easy answer for me, but it's important for you. And I have a couple disclosures I have to make as well. First, anything I say about stock or investments, I'm a broker, don't believe any of it. Talk to your own advisors about what's best. I have an insurance license. Anything I say about insurance, totally ignore it. Talk to your own advisors about what is best for you. And third, I went to seminary. I do weddings and funerals. Anything I say about religion, please don't believe it, and do talk to your own advisors, would you? I worry. Yeah. Anyway, those are my rules. Okay, any questions about the rules today? Good. Let's have some fun. Sometimes taxes can be sort of spooky, kind of scary, but what we're going to do is try and demythologize a lot of these issues and give you some basic information. So the first, where'd we go? There it is. Estate taxes. You know, in 2001, you had to pay estate taxes if your estate was over $1 million, or $2 million if you were a couple. Today, in 2023, the estate value is $12,920,000. So if your estate is more than $12,920,000, you probably need to plan. And if you're a couple, it's 25,840, 26. Yeah, it's a lot of money. And in fact, last year, only about 2,000 federal estate taxes were filed in the entire country. It used to be about 50 to 100,000 back in the day, because the levels have gone up so much. The issue, though, is that this $12,920,000 threshold is a 10-year window. It goes up every year, but at the end of 2025, it is scheduled to expire. And depending what Congress does, the feeling is that it will revert back to around $5 million. Now, that's a big gap between $5 million and $12.9. And so many people will be in that gap potentially, possibly, but it's important to be aware that it could change. Chances of it changing, who knows? Congress will probably decide it in December of 2025, so you can plan easily for the next year. But again, the important thing though is that we have what's called the step up in basis. Step up in basis says that whatever assets you have, the day that you die becomes the cost basis of that asset. So let's say you bought a stock for $1 10 years ago. If you were to sell that stock today, you'd have a $99 gain on that one share of stock. If you hold it in your estate, your heirs will receive it at a $100 cost basis going forward. So it's a way to eliminate, if you will, a lot of capital gain that may have accrued over your lifetime, and you pass it on to your heirs. So again, step up in basis is a significant tax strategy that has benefited an awful lot of people because it applies whether you have to file an estate tax return or not. And we're going to look a little bit more at this. It is any appreciated asset in the estate is updated to the value on the date of your death. So the stock bought at $1 when you bought it increases to the market value on the day you pass on. And at death, the cost basis of the spouse, if you're married, changes. It can increase significantly. And I'd like to show you how those numbers work. And in this case, I'm using in a house. In some cases, it could be an apartment building, it could be farmland, it could be stock, it could be all sorts of assets that appreciate in value. But let's imagine that it's a home or apartment building that is worth $3 million today. And the couple paid $500,000 for it. So if they were to sell it today, and just saying all sorts of things aside, they'd have a gain of about $2.5 million, which would mean they'd be paying taxes around 30 to 35% at the federal and state level. That's a pretty significant bite, I think you'd all agree. But what would happen at the date of the first spouse's death is the property would be appraised, and the spouse who survives, the beneficiary, would receive that half ownership at the current market value. And so the new cost basis for the surviving spouse is not her or his $250,000, half of the $500,000, but it now becomes $1,750,000 because the step up in basis on the deceased spouse's value is $1.5 million, plus her cost basis of $250,000 means that her total cost basis now on a $3 million property is $1,750,000. So that's an illustration of how the step up in basis can be so effective through your estate giving. Now, let's look at giving while you're living. You can give anyone you want to $17,000 a year, tax-free, no reporting, just give it to them. If you're a couple, you can give $34,000 to any one person. People go, isn't there taxes on it? No, because those are after-tax dollars. You paid the taxes on that money, and you are giving it to someone within the rules of the federal government that says you can give up to $17,000. Now there's some exceptions to this $17,000. The first is that if you pay someone's educational expenses directly to the school or directly to purchase the specific things, you can exceed $17,000 in giving on their behalf. The same is true for medical expenses. If you pay someone's medical expenses directly to the provider, then you can give an unlimited amount to pay someone's medical expenses or educational expenses. So it's a nice strategy, for example, if you want to reduce your estate and also make your grandchildren or help other people go through school, help the kids, help their friends, all of those things. So the bad news is the surprise that comes if you say, remember our stock for $1? Let's say you give it to your child or to a friend as a gift. Well, if you do it while you're living, that $1 cost basis becomes the cost basis for the individual you gave it to. So the cost basis of an asset follows it while you give it away during your lifetime. When you pass on, it steps up in basis to the market value if you hold it in your estate. And people do it. And I can tell you that 2 years ago, they were talking seriously about taking away the step up in basis. Oh my goodness. Congress was besieged by everybody saying, that's impossible. You can't do that. That would be terrible. We don't know what Grandpa bought that stock for in 1910. So many arguments. But the bottom line is that the step up in basis is a good estate strategy. Next, let's talk about assets that are not in your estate. And they are called income in respect to decedent assets, IRDs. And IRDs can be a terrible surprise. An IRD is income held in some form that grows tax-free over time. And it's only taxed when you take the money out. So examples of IRD would be commercial annuities. It would be IRAs, 401ks, 403bs. All of those are income in respect to decedent, and they are outside of your estate. The other up here is U.S. savings bonds. They are income in respect to decedent, and they're getting harder and harder to cash because banks don't want to mess with them. And if you have U.S. savings bonds, I would recommend, and again, talk to your own advisors, but that you cash them in while you're living, or you give them to individuals, younger people, children, grandchildren, who have a very low tax base, so they can cash them in. And that way, taxes for them would be reduced, and it is not in your estate because it is a nightmare trying to get rid of you. I use the phrase, trying to get rid of U.S. savings bonds in an estate. And we had one of our clients receive $25,000 of U.S. savings bonds from a donor in an estate, and we were not able to cash them in until we got the bank president on the board of directors. And then he said to the bank, his bank, he said, yeah, cash them in for them, would you? That was the only way we ever got it done because it was very difficult from an estate perspective to cash in bonds. Yes, ma'am. Question?
I have a question about that. I have an E-bond. It's $10,000, I think.
Mm-hmm.
So it's not huge, but it says payable on death and has my daughter's name.
Yes, the payable on death.
Would she still have trouble cashing it?
Yes.
I know she'd have to pay taxes on it.
She'd have to pay taxes. She could have difficulty. Payable on death, those of you who are familiar with it, payable on death is something you can attach to a bank account, to a savings account, to an investment account. That is when you pass on, you can automatically, that person receives the benefit. It just transfers to them. And it is taxable to them, certainly.
Well, I know it's taxable.
And I tell you, PODs get tricky sometimes. We're having a lot of hassles sometimes getting those banks or investment firms to recognize them. But you can build your estate around payable on death plans. We've had donors who don't want to go through court, they don't want to go through attorneys, so everything they have is a payable on death account. And then in this case, it was a hospital donor who gave the hospital foundation, the Susan of the hospital foundation, a list and said, when I die, call these banks and here are the account numbers for you. And so we had it on file, and then the hospital did something that upset this donor. I won't go into details. He was very upset. He thought, I'm going to not give them money. But then he realized how hard it would be to go in and change all of those payable on deaths. So he became much more amenable, and we were able to work out some things to his satisfaction. So you can use it as, we have a whole session I can talk about estate planning and payable on death. Great point. It's a very useful tool. But tax liability does occur.
But with savings bonds, it's a pain in the neck.
It's a pain in the neck. Yes, question.
You know, a number of years ago, my mom and dad are, my mom and dad are both deceased now, but they had savings bonds, and I remember mailing them to an address in Minnesota.
It's a clearinghouse.
I redeemed them that way.
Yeah, there was a clearinghouse, and the feds used to do it, but it's in the last 10 years, it's become such a mess.
You mean that's not an option anymore?
It's an option if you can convince them that you have the power and authority to do so. You have to send them all the documents.
It was not too big of a, okay, thanks.
Yeah, trust me. If you have them now,
get rid of them. Well,
talk to your own advisors about what is best in your own situation.
Right. They're all redeemed now, but for the...
Oh yeah, no, that's good. My mother died in 2022 in Pennsylvania, and I was the executor. And I can tell you from personal experience how difficult it could be.
Good.
Personal words.
Okay.
Just a thought. Okay. So we know that income is fully taxable in an income in respect to decedent. So if you have IRDs or you don't know about it, what you want to do is to review your assets with your advisors and understand what your IRD issues might be. Where do you have tax liability? And as we're talking about bonds, possibly cash them out now, but avoid taking a big tax hit. Because if you have a lot of gain, it pushes you up into higher tax brackets, which could be very painful. So again, IRDs require good planning and strategy. And whatever you do, yes, be prepared. Question?
I have another question.
Okay, here comes the microphone.
This time it's an annuity, and I know it's taxable, but what if I give it to a World Wildlife Fund, say?
That would be great, because charities don't pay taxes.
They don't, on that sort of thing either, they don't.
Correct, they don't pay taxes.
Okay.
So you can leave your IRA.
So if I change the beneficiary,
to,
it's okay.
It's okay, it's to a charity. We're going to talk a little bit more about that strategically in a second. I always say I owe someone $1 if they take me to the next slide or two. So, Susan, keep track, would you, for me? So, let's talk about a problem related to this estate planning issue. The Secure Act is actually two different acts. One was passed in 2019, excuse me, the other in 2022. And Secure stands for Setting Every Community Up for Retirement Enhancement. Secure. I'm sorry I didn't spell it out. But it's Setting Every Community Up for Retirement Enhancement. And what it did, excuse me, is that historically, the strategy of dealing with IRAs or pension plans was to stretch the payments out by naming young children or much younger people at a lower tax bracket as the beneficiary of your IRA. Excuse me. And this way, that IRA could pay out a lot of money over a long time without a great deal of tax liability to the heirs. Well, that changed. All of those years of tax planning on the stretch IRA, like a rubber band, it snapped back. And in 2019, Congress said in the Secure Act Point 1 that IRA beneficiaries have to take all of the money out within 10 years of the death of the donor. And so that means that the concept of the stretch IRA, spreading payments out a long time to heirs, is no longer valid. And so there are different ways to deal with it. Simple thing, just like your question about the annuity, what you can do is you can take, if you're planning to make gifts to charity in your estate plans, and that's an if, what would you do is you put your heirs back into the estate and you name the charities as the beneficiary of your IRA or other IRDs, because they will not have the tax liability. And your heirs will receive the same amount of money through your estate that they would have otherwise. So again, this is a strategy, and there's other nuances around this strategy to do things, but it's where you may want to talk to your own advisors about what is best excuse me, for you. So the Secure Act is bad in that regard. It changes the rules, and you need to be aware of the rules. And sometimes we feel trapped by all the changes in rules we don't know about, and we don't know what's behind the door. This is a good surprise. Many of you may already know about it. If you're over 70 and a half with a traditional IRA, your custodian can transfer money directly from your IRA to a charity. Excuse me. And if you do it, every dollar you transfer, and it's called a qualified charitable distribution, a QCD, every dollar you transfer reduces dollar for dollar the amount that you have to take as your required minimum distribution on an annual basis from your IRA. So this is a great way to save taxes directly. It is a way to take money that you would give to charity, give it to the charity like you always have, but also save more in taxes in a significant way. So it is a, oh my goodness, we're reloading. Oh, thank you.
You're welcome.
Thank you. Oh, thank you. Thank you. Oh, look at me. I'm gonna just stand up here and drink. Forgive me.
You need to.
So every qualified charitable distribution, if you've not used it, is wonderful. And I've learned over the years that it takes 5 or 6 times to hear it to really have it make sense. So I repeat it once, and back in November when I'm here, I'll talk about it again, because it's a wonderful, I love it. It is one of the best things you can do. A couple restrictions is it can only come from an IRA. Can't come from a 403B, 401k, other pension plans. It has to be an IRA. Now you go, what about a Roth IRA? Well, you can do it, but it doesn't make sense because the money isn't taxable when it comes out. So again, Roth IRAs are a little bit different. But the other thing about Roth IRAs is that the same rules that apply to the traditional IRA for taking the money out in 10 years also apply to the Roth IRA, even though the money isn't taxable. So you need to make sure that in your planning, you're aware of this 10-year rule and adjust your plans appropriately. So doing a QCD is easy. Actually, in one community where I meet with them fairly often, we had a contest to see who could do a QCD fastest, which was they had their computers set up, they went to the websites, they punched buttons, and it took 4 minutes was the record for moving it from the custodian over to the charities or charity that they wanted to support. So doing a QCD is easy, and the taxes are very effective, and I want to show you how that works. This is a made-up donor. No real person involved here. But let's say that this donor has an adjusted gross income, the AGI, forgive me, 10 years in DC, I go, QCDs, IRAs, yeah. is adjusted gross income $100,000. Of that $100,000, the donor has $15,000 in his or her required minimum distribution. So this donor annually gives $10,000 to charity every year. It gets the money, they write a check to the charities they want to support, and they don't itemize because so few people itemize anymore with the changes in tax laws. What they do is they take the standard deduction and they pay out $10,000 out of pocket to the charities that are important to them. Now this donor goes, wait a minute, I could do a qualified charitable distribution for $10,000 that my custodian would send directly from my IRA to the charities I'd give the money to anyways. And when I do that, that means that I don't have to take $10,000 of cash or stock, you can do all sorts of things, out of my IRA. So this donor, let's say, is in the 24% tax bracket. That is, at the highest level, 24% of every dollar, 24 cents, goes to the federal government. What happens, if they reduce their income by $10,000, they now are saving $2,400 direct cash, not paid to the government. And if you go to the next slide, you'll see, again, my brain thinks conceptually, it's how I think, but a lot of people think of charts. So here's our 100,000 with the 15,000 required minimum distribution, 10,000 to the QCD, same as the current gift, drops down to $90,000 of adjusted gross income that saves $2,400 in taxes. And this donor has not changed anything that he or she would normally do. But they now have $2,400 more to spend without giving it to the federal government. So it's a great tool, and if you're not using it, you should talk to your own tax advisors about what's best. Yes, question? I like questions.
Most of us, or many people here, can take the itemized deduction because we get a big write-off on medical junk.
Correct.
How does it work out in that case?
Well, in that case, it still doesn't matter because your $10,000 in charity is on after-tax dollars.
But when you give that to charity, you can't take it off as an itemized deduction. Though.
That's correct. But remember that you're paying taxes on your adjusted gross income as your cost basis. So if you reduce your adjusted gross income, you reduce the impact of your deductible Schedule A stuff. So you're really ahead of the game by bringing down your adjusted gross income. Even with, now, I mean, you get into this what if. So if $10,000 makes me eligible to itemize, and again, that comes down to a lot of questions. Yeah, now we're getting into tech complex. I love tax stuff because your medical expenses have to be in excess of 7.5% of your AGI. So if you reduce your adjusted gross income, then your 7.5% ceiling drops down, so you get more deduction from your medical deduction. And that $10,000 you gave to charity is gone and you're better off. Okay? I love taxes, thank you. I'm sorry, I don't know if you people love taxes as much as I do. I get the Kiplinger tax letter and it comes every Tuesday and I get so excited because it's like, wow, what's happening in taxes today? And you know, I've been getting it for 25 years, I love it. Anyway, other questions, I'm sorry. Okay. Let's take a look at some other lurking surprises. One of them is not taking your required minimum distribution in a given year. Another is if you've set up a 529A educational plan, we'll talk about that, and you don't use it, or the people who you set it up don't use it, there could be some traps there. Underpaying your estimated taxes, if you pay quarterly taxes, you can get into trouble sometimes there. And there's some other scary, sort of more nuanced things that we'll touch base on. So let's look at not taking your required minimum distribution. Here's some good news. The penalty for not taking your required minimum distribution has dropped. In 2022, it was a 50% penalty, and in 2023, it's only a 25% penalty. So if there was ever an incentive not to take your RMD, the fact that you could save 25% in penalties, I'm sure, is very enticing. But the key thing is that most people take their RMD. Your systems, your custodians really push you to do so. With your RMD, you can take it as cash, you can take it as specific stocks or holdings and do a journal transfer over to your personal account, which then gives some more adventure to the process, if you will. But these are things that you should talk to your own advisors about what is best. And if you do make a mistake, an honest mistake, you can file Form 5329 just in case you had to deal with it. So it's a very sort of obscure rule, but it is a surprise if you don't always take, and sometimes, because if you have several IRAs, you have to take the composite of the aggregate of all of them, and you take it out of one and you miss one and you underpay, you have an issue. So always pay attention to what's going on in your required minimum distribution payments. What's a 529A plan? Are you familiar with 529A plans?
Yeah.
Educational funds, I hear a couple. A lot of people do, a lot of people don't. Basically, it's been the tax savings mechanism for education since 1996. Prior to 1996, if you wanted to plan for someone else's education, you could do a uniform gift to minors, UGMA. You could do certain gift funds that would distribute to them at a certain point, like when they hit 18 for college or whatever. The problem was that once you set this up, if the kid decided not to go to college and buy a convertible instead, that's what would happen. You couldn't control the intent of the educational fund. So the 529A was set up as a tool to focus only on tax savings and tax benefits for educational expenses. And it is essentially, you can put in $17,000, remember a number, $17,000 a year as a gift, $34,000 as a couple, and you can prepay it. So you could pay, if you were just setting it up, a new grandchild, for example, you could put in 5 times 17 is $85,000 the first year and then not make any gifts for the next 4 years. So you could jumpstart the 529A plan. And so it's a nice tool. It's very defined about what can be done. And in terms of every state, it offers a different 529A plan. And in New Jersey, it's never simple. I don't know if you've noticed that about New Jersey. I lived here for 7 years. It was never simple. If you live in New Jersey, you can sign up for the New Jersey 529A plan, buying the assets, the stock, it's a mutual fund, held directly by the mutual fund company. You pay a very low fee, and you receive a nice tax credit starting in 2022 for doing it. And if you don't live in New Jersey, but you want to do it in New Jersey, you have much higher costs to do it. So different states have different benefits. And I put in the njbest.com if you want to learn specifically about New Jersey incentives for 529A plans. And you know, it's a confusing business because Congress, in the Secure Act, I believe in 2019, allowed for kindergarten to 12th grade to be a benefit or be used by 529A plans. And so that confounded everything because several states like New Jersey give tax credits for people to set up 529A plans. And the fear was that every child who was in pre-kindergarten, preschool, nursery school, could set up a 529A plan for their child, put the money in, take the tax credit, then take the money out and pay tuition. So there's a lot of rules that have been built up in the last few years, but do take a look at the website if you're interested in those details. 529A plan works this way. It only goes to one person, but it can be transferred from one person to another. So let's say that you have someone who didn't go to college or didn't go to trade school, it can be used for trade school, just, you know, I don't know, join the army, whatever. that could be transferred to someone else, that buildup. You can have multiple accounts. There are no limits on how many individual 529A plans you can have in place. So let's say you have 10 grandchildren, you could have 10 529A plans, one for each of them. And anybody can contribute to that plan. So if you have grandchild number 7 and the parents of grandchild number 7 want to kick in, they can put money into grandchild number 7's fund as well as you or anyone else. And the key thing though is don't close it. That's where it can be painful, because first of all, there are some good news and bad news as usual. The bad news is that if you take the money out for non-educational expenses, or you take the money out because nobody's going to use it, boom, you get hit with a 10% penalty over and above all the taxes that you would owe on it, taking it out for non-educational expenses. That's the bad news. The good news is that in 2022 rather, the Secure Act 2.0, the second Secure Act, allowed for you to, any beneficiary of a 529A plan could take $10,000 out to pay off student loans. So that can be very significant in terms of money that was used that didn't build, that was not used, could be used to pay down college debt or educational debt. So it's important. And unused funds up to $35,000 can be converted over to a Roth IRA under certain circumstances. And those circumstances are, you can't just do it willy-nilly. It basically needed to be in place for a long time before you can do that transfer. But that's new stuff that's just happened last year around the 529A plan. And if you're using them, they're great. If you don't use them, don't worry about it. It's a tool. Let's talk about estimated payments. I know September 15th was a due date for the third quarter payment. I don't know if any of you had to write a check, but I'm sure it was not a pleasant experience if you did. And the problem with quarterly payments, estimated payments, is usually your tax advisor at the end of April 15th gives you 3 voucher forms and says send one in September 15th, January 15th, and then April 15th again. So it's June 15, April 15, June 15, September 15, January 15. Not an easy quarterly schedule to remember. But what could happen over the course of a year is you could get some spikes in income or you could get some drops in income. And so estimating, if you're on a steady line guessing what it was, you may be over or under your estimated payments. If you're over, you may want to adjust your January 15th payment to bring it into line. But if you're under, you can avoid estimated tax penalties if you owe less than $1,000. So you can do that. If you paid 90% of what you paid this past year, you paid 90% of what you owe this year, so you owe $10,000, you paid $9,000, you're okay. And finally, if you paid 100% of the taxes you paid last year, you'll be okay, even if it moves around a little bit. So that's sort of the basic rule about it. But, and this is the hook, if your adjusted gross income, your taxable income, is over $150,000, while it is still 90%, if you paid 90% of what you owed, you're good. But if you used last year as your marker, you had to pay 110% of what you owed last year. Otherwise, you're exposed to a penalty. So these are just some basic estimated payments. I stress the importance of adjusting your estimated payments as you go through the year, something you want to work with your advisors. Because my theory, and this is my theory, personal theory, everybody, remember our rules, has a personal approach. My rule is I don't want to use my tax dollars as a savings piggy bank where I get a big chunk of money at the end of the year because the government's sitting on my money all year. I don't want to underpay because then I'll have penalties. So I just want to find that Goldilocks moment where I've withheld or quarterly paymented enough just so I'm okay. I get $100 back, I'm happy. I owe $100, I'm happy. no surprises. So again, it's a strategy about how you want to function. People go, I don't want to get in trouble with the government, I'll give them everything, and if I get some back, that'd be great. Or some people go through, as they're working, withhold extra money, so then they get sort of a April 15th bonus. Everybody's different about their planning. So look at your estimated payments. I can't emphasize that enough now, between now and January 15th. Some other scary phantoms: forgiveness of debt. If you've loaned your kids or someone money to buy a house, and then you say, okay, you know, person I've lent money to, I love you, you don't have to pay me back. They go, wow, thanks. But guess what? That is phantom income to them, and they have to pay income tax on that forgiveness of debt. Very straightforward, very simple. Forgiveness of debt means you have to pay taxes on the income that was forgiven. Remember in the 2009-2010 mortgage crisis, and then basically banks cut new loans and everything? Congress made a special act to exempt that wiping out of debt or restructuring of that debt to be non-taxable. But forgiveness of debt is a surprise, phantom income. If you have a K-1 that reports income, even though you didn't get anything from it, that too is phantom income that you have to report and pay taxes on going forward. If you have limited liability corporation ownership, if you have cash distributions, if you have depreciation, eventually that is going to be phantom income you have to pay taxes on. So again, these are very secondary issues, but it's important to be alert to potential surprises. I mean, I've seen great deals crash because the seller, for example, just realized how much tax he or she would have to pay if they did the sale. They go, no, I can't do that. These are one in lifetime things that happen, or a couple times. Just be aware that they could happen. So wrapping up, the best way to avoid surprises is to work closely with your advisors. Know what your assets are, so you know where there could be problems. Look at what IRDs, income and respect to decedents, you have issues, other tax issues to be aware of. Think about ways to avoid the unexpected. And if you remember Hill Street Blues, the deputy always said, be careful out there. That sort of reminder is pay attention. And guess what? This may not be a lake in New Jersey, but it's a beautiful way you can relax and look at the sunset, because you know that you're not going to be surprised. So that's our point today, is that there's a lot of moving parts in tax law. And while you're aware of most things, there could be surprises that occur from time to time. So questions now or more information, you can reach out to Susan or to me, and we'll be happy to answer or try to answer whatever you want to know. Questions up here, Susan? Oh, okay, coming through.
I don't know if this is in your domain, but can you say anything about the Anchor program?
The program?
Anchor, A-N-C-H-O-R.
South New Jersey State Income Tax.
Oh, okay, the New Jersey State Income Tax Program. I don't know it, but I will tell you that I've learned a lot about New Jersey taxes because my daughter worked full-time for a year in New Jersey, lived in Brooklyn, and has a permanent residence in Los Angeles. And what I found was, and this is just me commenting because I have no clue about Anchor, and I'll look it up, trust me.
Oh,
but New Jersey state income tax web pages are 3 to 4 years behind. I couldn't find a lot of information because a lot of the pages I needed were last updated in 2018. Just as a comment, I'll have to learn about Anchor. Thank you for asking. Other questions?
Yeah.
Yes, up here.
I'm curious about the, let's say a parent lends money to a child.
Mm-hmm.
And there's nothing in writing. It's just, okay, I'm going to lend you, let's say, $100,000. Well, I know it has to be no more than $17,000 a year. But let's say someone's ignorant of these and say, okay, I'm gonna lend you $100,000 and lend you, right? And there's no paperwork, no contract or anything. And then down the road, it's forgiven. Well, how does the government know that this is done? I mean, so legally you're supposed to declare that $100,000 gift? I mean, I wonder how the government gets into this if there's no paperwork, no contract.
Well, sort of no paperwork, no contract is sort of not, that's why the government doesn't allow it, basically. There should be, if you're a parent and you're loaning money to your children, you should have a written document in place that specifies a market rate interest. So even if you say, okay, you want to buy this house, the market rate interest is 7%, I'm going to charge you 3%, that 4% becomes a liability to them as well. It's, parents do things, kids do things, these things happen. This is where you talk to your own advisors about what's best in your own situation. That's what I would say. I mean, you could do it like $34,000 a year as a couple. I mean, yeah,
My
good
parents
question.
used to lend small amounts of money to my brother, but there was always paperwork involved, and fortunately, upon his death, it had all been paid off, so I didn't have to deal with that. You know, with these.
Yeah, and documentation is always helpful if the IRS audits them. He's like, where'd this $100,000 come from?
Yeah, I know. Okay.
Look, audit rates are down. I mean, audit rates are less than 1% right now, particularly under 400,000 with everything. Yes. Other questions? Okay, well, great. Thank you so much for your time. You can tell I get excited about taxes. Sometimes I start bouncing up and down because I get so excited. So, I just, 30 seconds for one story. I served a church for a few years in a rural area, and sometimes we'd have a joint service with some of the other churches in the area. And when we'd be at the Baptist church, the podium where we'd sit was above their baptism bathtub, if you will. I don't know how else to describe it. And their pastor would get so excited as he was preaching that he'd be bouncing up and down. And this other pastor and I are sitting up there thinking, oh my goodness, this is gonna collapse and we're gonna be in the bathtub. Sorry, he bounced and the whole thing was shaking. We're like, whoa, what's gonna happen to us? So I try not to bounce. Anyway, thank you for your time very much. I'm happy to answer questions individually and appreciate your time.
Good.
Thank you.